on a bottom-up basis. So we don't invest based on themes or the general uptick in Europe or any strength in currencies. We look for self-help companies which are either growing into new marketplaces where they have a clear R&D focus, or a value-based company which is reorganizing production, changing their operating cost base, and essentially readjusting so that they're able to show a good improvement in return on capital through time. So we have a clear focus what we're looking for. And in terms of execution of that, we meet a very large number of companies each year. We meet more than 400 companies across Europe every year. And that can involve conferences in Europe, or conference calls from our office, or actual company visits. We screen through these companies very carefully, doing very detailed analysis of each individual name, making sure it satisfies our criteria. And essentially, what we're trying to find is companies which will surpass expectations on operating level and generate earnings which are above what people expect at the moment. Through that 400 company list, we break it down into 20 to 25 long names, 10 to 15 short names. Once we have the portfolio, we're then quite active at trading around the names. So if the stock's volatile, we'll try to move in and out of it and take advantage of short-term alpha. If it's more stable, we'll leave it alone. And if we think we've made a mistake, we'll change our mind and cut the position immediately. So from a bottom-up perspective, that's the thrust of the fund, and it's very labor-intensive and very hard work, but it enables us to derive a portfolio of high-conviction names, which, like I say, are generated by self-help measures, not particularly based on how the European economy is going. In addition to that, we also have a sentiment framework which protects the fund during times of distress. So if I think the European stock market is too optimistic and people are too bullish, then I'll buy some protection, reduce the net exposure, and become more careful. Contrarily, if I think investors are nervous and there's more chance of a rally, then I'll let the fund go more net long. The conjunction of those two approaches generates the return that we've seen so far.
Yeah. I would like to remember that you manage 120 million euro, right?
That's correct.
That's correct. Yes, correct. In particular, would you comment the first quarter 2014 performance of the fund, which was obtained in very different market environments?
Yeah, essentially, the performance during the first quarter was driven by the two elements I've mentioned. So the first element, individual stocks, which are going to generate returns based on self-help, generated 2/3 of the performance. The other 1/3 came from protection, as in Eurostoxx puts that we purchased in December 2013. So in particular, the three individual names, there's three stocks which I'll highlight. The first one is Abengoa in Spain. This is a construction concession company which I've known for a long time but never invested in. Essentially, it builds concessions across the world in renewable energy, and this can be in solar farms, wind parks, transmission grids. Over the past 10 years, it's invested successfully in Latin America, the US, and parts of Asia. But the CapEx program has been so aggressive that it's consumed all the free cash flow. Now, I met the company in the autumn of 2013, and I realized the tone was changing. So essentially, they were focused more on balance sheet deleveraging, disposal of non-core assets, and shrinking their CapEx budget to a level which was more reasonable. I was impressed by the investment case that the CEO rolled out, and I realized that despite any macro occurrences, there's a lot the company could do to improve its perception and generate an improvement in returns. So we established a large position in that stock in the latter part of 2013. And it performed very well during 2014 based on a recognition of the investment case coming to fruition. Some disposals were happening, and also the investment community realized that the strategy was changing, and so it re-rated aggressively. Two other names I'd mention. One would be Ubisoft in France, which is a manufacturer of games. It makes games for the PlayStation and the Xbox. The market's been difficult over the past few years because the older generation of hardware has basically been aging, and the number of games sold has been in decline. Now, Ubisoft has survived a difficult market by focusing on core franchises and investing a lot in R&D in its games. So again, it's self-help based on the company itself doing something innovative to drive its performance in this market. So now it's in a position where it has 3 of the top 10 games which are due to be launched during this year, and they should take advantage of a better marketplace and also growth in their market share. And that will lead to a large improvement in their operating performance and a big growth in earnings over the next few years. So that performed well during 2014. I think will continue to perform. And the final one is Greencore, which is an Irish food company. Essentially, it provides ready-made food for the UK retail sector, which has been growing quite slowly but steady. But more importantly, they've been making links with Starbucks in the US. And Starbucks are going to increase their food offering quite significantly, starting in the East Coast and then rolling out across the US to try and compete more in the lunch market. Greencore are linked closely to Starbucks, and so we'll be able to grow in line with their food offering from a revenue in the US of about 200 million at the moment to 1 billion in 5 or 6 years' time. The margins in the US are currently low, but should recover nicely with this extra revenue. That story again has gained traction and been realized to be a good long-term case, and so performed well. So those 3 names all performed well for stock-specific reasons during 2014. It was nothing to do with the fact that Europe was recovering or any change in the macro environment. It was to do with initiatives taken at a company level, and that's what we tried to find. The second part of the performance, the puts, we basically purchased puts in the end of 2013 because our sentiment indicators told us that the market was quite warm and quite optimistic, and we thought the chance of a pullback was reasonable. So we reduced our net exposure by purchasing out-of-the-money Eurostoxx puts on the Eurostoxx 50. And then in January, following the correction, we disposed of half of those and let the fund go slightly more net long, and then repurchased them later. So it's the 2 points to the strategy working in tandem during the first quarter of 2014. The most important being the stock picking, and then the protection and sentiment-driven part helping a little bit this quarter.
Marc, how important is tactical management of gross and net exposure of the fund?
The main thrust of the fund is stock-specific self-help cases, and that's what we spend all our time trying to find. So we spend hundreds of hours and doing hundreds of conference calls trying to find a handful of names in Europe where we think the self-help case is strong enough to drive returns irrespective of what else happens. And that takes a lot of finding. That said, at times of stress, it's important to manage gross and net. It's important sometimes to drop the gross exposure quickly if we feel that correlations are about to rise or the market's going to move more into a macro-driven scenario. It's important to drop the net exposure if we feel that sentiment is too optimistic. So we try and be preemptive in our moves to position the fund to take advantage of these changes in sentiment. So ahead of a pullback, hopefully we purchase protection, and then if the pullback actually happens, we're able to add to our core longs and take advantage of the situation rather than deleverage at the wrong time and having to sell into weakness. So that's what we're trying to avoid.
Certo. Marc, please describe the outlook for European equities in 2014.
Over the past 12 months, the European equity market has re-rated quite well, and that's despite the fact that earnings estimates have come down. So the forward PE multiple on the European stock market is about 14.5 times. So it's higher than it was 12 months ago, but it's not stretched compared to other asset classes. If you compare a European large cap equity to the bond market or to US equities or to a property fund, you'd find that the yield is still quite attractive. On lots of large cap stocks, you can find yields of between 3.5% and 4%, which is difficult to find anywhere else. So from a top-down perspective, we think as an asset class in its entirety, it's still relatively attractive. In terms of the work we do, obviously we see a huge number of companies, and so we can assess the earnings estimates bottom-up. Our bottom-up assessment of the companies suggests that estimates for 2014 and 15 are rather fair. We don't think they look stretched. We think they rather look reasonable given the environment that's occurring at the moment. And then in addition, one other factor is the M&A, which is coming into play again in the markets. From the feedback I've had through lots of company meetings, we found that companies are much more willing to use their balance sheets now than they have been in the past 2 years. They're not willing to gear up to the level they were 6 years ago, but they're willing to put some leverage into their balance sheets and take advantage of low interest rates and help consolidate their marketplaces. In lots of instances, there's quite a lot of opportunities to buy smaller players and grow in quite an accretive way because money's so cheap. And so they're more willing to do that now than they have been before. That's another factor which helps the market. That said, I don't expect a strong beta-driven market the way it was in 2013. I rather expect a more range-bound market between perhaps 0 and 10% return for the year, but quite volatile.
Yeah. How should your strategy perform in such a scenario?
In terms of a long-short strategy, there should always be something to do, provided correlations aren't high. So provided the market isn't macro-driven, there's always opportunities on both the long and short side. And we track these correlations very closely. So we track the correlation of our top 5 names with each other, and we track the correlation, as you've seen, of the fund with the overall market. So in terms of our top 5 names, the correlation is only 0.22, which is a good number, which means there's quite a bit of dispersion in the market. So provided there's enough dispersion, which currently is, then the strategy can perform fine. At the moment, we see the market in equities is behaving quite rationally. Companies which are delivering good numbers are being rewarded, and companies which disappoint are suffering. And the reaction is reasonably fair in both ways, implying a reasonable market for stock picking at the moment.
Yeah. What are not good conditions for strategy?
The worst conditions for the market, for our strategy in the market, is when correlations are very high and dispersion in equities is low. That happens now and then when macro factors dominate the market. So if something disastrous happens in the macro economy, a crisis in Latin America or a war or any sort of financial crisis, then for a short amount of time, correlations can become very high. And in that case, the strategy ceases to function during that time. Now, if I think we're moving into a more difficult period, I will try and be preemptive and reduce the gross exposure. So my first reaction to the strategy not working is to shrink the gross exposure to a more defensive level, which would be 50, 60%, compared to a normal 110, 120%. And bring the net exposure down to 0. I've done that a few times with the hedge fund to defend the fund during times of stress. So if I think the strategy is going to not work for a while, or there's going to be stress, then I'll react at a gross level and shrink exposure. But then when the conditions normalize, I'll reinitiate the stock picking strategy and increase the gross exposure again.
Yeah. Please outline opportunities you see on long and short side.
In particular, on the long side, on a self-help name, we think Fnac in France is a good self-help long name. It's an electronics retailer based in France, but also with Southern European exposure. And essentially, it's suffered in the past 3 years because of price deflation in its segments. So it sells CDs, DVDs, games, peripheral accessories for gaming in its stores, and it's faced competition from Amazon, which has led to price decreases and pressure on the revenue. Now, we've met the management several times over the past 12 months, and we think they have a clearly innovative approach to defend themselves against these trends. They're repositioning the company more towards the mobile area, so they're using mobile applications and also accessories which have good margins on them to displace the space that's being freed up from the CDs and DVDs. And that's leading to a gradual stabilization of the revenue. In the fourth quarter, revenue was almost stable. And we think going forward, revenue should be around stable at 4 billion euros. The company have also addressed the cost base, reduced the leases and reduced their personnel. And so there's a lot of leverage potential in the margin in the event of demand stabilizing. The margins are low at the moment, but with a lot of leverage in them. We think the operating margin can go from 1% currently to 3% midterm, in which case we think the stock should be worth about 50 to 55 euros. It's now about 36. It's performed well during 2014 based on the fact that people have realised that their strategy is bearing fruit, but we think it will continue to perform.
No. And Mark, which sector of the market are most favored by the investor strategy?
We're very keen to avoid what we call hot sectors, so areas where there's a huge amount of investor attention, where there's momentum, and where valuations aren't so important. So at the moment, we think online retail, until very recently, has been a segment of the market which has received too much investor attention. Obviously, there's a substitution effect happening from offline to online, and that's creating a reasonable dynamic environment, and some companies are exploiting that. But we feel that the overall appetite for the space has become too intense and it's too much of a crowded area. Also, we would say European cyclical plays, companies which are benefiting purely from strength in the European economy, have also re-rated to levels we think are now more fair. From the meetings we've had in the past few months, we see the European environment as more stable. So the European economy is better than 2014, but we don't think it'll show dynamic growth. While in some instances, expectations have gone ahead of that, now discounting a strong recovery in some marketplaces. So for instance, we've been short of some construction companies, for instance, BAM Group in Holland, which is a company I've known for a long time. We think that investors are expecting too much of a rebound in the housing market in Holland and too much of a recovery in overall construction. We think construction will recover, but not quite as much as people expect. In addition, there's quite a lot of capacity in certain marketplaces, which means that there's no pricing power. So even if volumes recover, it's difficult for margins to improve materially because there's so much capacity. And we think that will affect BAM Group's returns in the next few years. So into strong momentum, we've been short of that.
Yeah. Are you also finding opportunities in peripheral Europe?
We're quite opportunistic about where we look. We're not wedded to any particular area. Northern Europe has been a big focus for us in the past, but we're quite flexible. We'll allocate capital anywhere where we see ideas. In terms of peripheral Europe, we found two stocks in Portugal, which we quite like. So one is Motor Engil, which is a construction company focused on the African region. It's very close to a lot of the large mining companies who have big infrastructure projects in Africa. Their order book has developed very favourably, and we think it will continue to do so. Africa, in addition, has got much higher profitability than construction in the rest of the world, and that's because you need local government contacts and contacts with the right companies to be able to operate there. So that company's performed quite well so far, but we expect it to continue to re-rate, and it's very cheap. We've also bought a Portuguese company called ESS, which is an operator of hospitals in Portugal. It's a private operator of hospitals in the Portuguese market. Now, Portugal in general has been a difficult environment because of the economy and because of pressure on budgets. That means that public provision of healthcare has been deteriorating slightly. And for people who can afford to pay, this has been a good opportunity for the private sector. So they offer 3 good quality private hospitals which do a number of operations, and they have quite a lot of pricing power and a good volume growth based on the fact that there's part of the population who want to pay for private care. And so they've been able to generate good free cash flow from this business and are reallocating the free cash flow into some interesting areas, expansion of their current facilities, and also some international ventures. So the company has about a 10% free cash flow yield, and the management are very good and are focused on reinvesting the cash at good rates of return.
Yeah. The last question, looking at the end of the year, what are your targets?
Essentially, given that we keep the net exposure relatively contained, the performance is mainly driven by the stock picking. So the self-help stocks on the long and short side drive the returns. So keeping volatility relatively low, we target 10% or more return overall for the year, irrespective of where the Euro Stoxx 50 finishes, with a contained volatility of 6 or 7%. So we'll keep volatility down by trading in and out of the names when we see fit, and also buying protection when it's cheap to do so, when the market's optimistic, and when volatility is low. and then selling that protection if the market becomes more nervous. So buying and selling protection in a contrarian way while keeping our focus on self-help stock cases is how we intend to drive the return.
Okay, thank you very much, Mark, and good luck. Okay, thank you.